Good afternoon, everyone. Welcome to the Daily Recap. I'm Evan Lazarus. I'm CEO of T3 Live. And before we get into the recap and talk about the market, and as I think the punishing trade continues, I want to briefly do just an announcement here. For those that are unaware, if you jump over to the T3 Live homepage, I want to make sure you're aware that we have a webinar, a big webinar going on today. Begins at 4:30, so if you're not tuned into it, make sure you sign up here. Again, you can sign up on the upper right corner here where it says free webinar. And the webinar is going to feature Mike Lee and Steve LeVay, two of our educators at T3 Live. They're going to focus on how they trade the first 2 hours of the day and how they thrive on that opening range trade. So make sure you tune in. Just some other events that we have in upcoming. What I learned while losing money, which I know sounds a little bit strange, but that'll be a webinar where I'm going to go over some of my experiences when I was trading and what I learned and how I evolved as a trader. So for those that are so inclined, some interesting informational events that I'm sure, or I hope that you'll be able to pull some quality content out of. So don't forget, today at 4:30, the Mike and Steve active trading first 2 hour webinar, and then next week we have my webinar where I'm going to hopefully share some good stories and shed some light on how I evolved as a trader. So what can I say about the market that I think hasn't been said? And I'm going to try and put my spin on it, as I always do. And we're going to talk a little bit about the broader indexes, then we're going to look at a couple of symbols. I'm going to try and keep it short and sweet and to the point, although I tend to say that but not follow through, so I apologize in advance. But we're going to look at the S&Ps, we're going to look at the Spyders. And you know, in a tough tape or in a tape where you have a flat 21 EMA, and it's something I talked about, you know, a couple weeks back on the morning call. It can be a very, very dangerous market. Breakouts will fail, breakdowns will fail, and while you might get excited one day, the next day can be the complete opposite type of experience. And that's basically what we're seeing here. If we kind of segment and bracket off, you know, the last 2 months of this, just the general markets here. And again, the general markets are not reflective of individual stocks, but you know, it does give us a sense of, you know, what's happening overall, and you know, we can kind of tell a story from this. And you know, we talk about range, and you know, basically we have range, and I highlight that range here with these two horizontal lines, and you can see support and resistance, and it's basically a reflection of turning points. And just like down here, when the market looked like it was about to break lower, as we broke the range, we jumped back up, and yesterday again, jumping out of the range to the upside, we turned back down. So you don't want to chase a sideways market. You don't want to buy breakouts effectively and be paying up. If you're not skilled on how to trade a sideways market, again, just a time for me to plug the Active Trader program, where we talk about range-bound trading and effective tools for successful range-bound trading. But if you're not, you know, if you're approaching this in the same way you did 5 months ago or 3 months ago or a year ago, you're probably not getting the same results, and moreover, you're probably banging your head against the wall. I know how frustrating a market like this can be for those that are experienced, and you know, every time you've bought a breakout over the last, let's say, 2 years, or you know, you've had a higher probability of success. You're not going to see that right here, right now. When it changes, I can't tell you. I don't have that crystal ball, nor does anybody else. But what I can tell you is you have to be very, very careful about picking and choosing your battles in this type of environment. Now, if we flip around to other indexes, you see, you know, big cap, the Dow. Here's the diamonds again, holding in, showing, you know, relative strength, if you want to call it that, but basically staying in this sideways trading market. You're going to get little pops where you get this, hey, we made new highs, followed by 2 days of the opposite direction. Very, very tough. But then you flip to the other side of the coin, and again, I'm not saying anything I haven't said before. You have some of the mid and small caps. We'll look at the Russell 2000. Here's the IWM. Much weaker. Clearly, you know, declining averages. Every bounce we tend to come back down. And again, in the Qs, you know, again, a weaker looking index overall. So, you know, what does that mean? Well, it means what it means until it, how do I say it? Let me put it more eloquently. If it walks like a duck and it quacks like a duck, chances are it's a duck. And what I mean by that, in my ever so eloquent way, is that something isn't right. And it doesn't take a rocket scientist or a genius or anybody that's had, some time spent in the markets to know that the broader indexes should follow suit from one another. And there are clear divergences here. As you look around some of the big momentum names that you tend to, hear a lot more chatter about, some of those stocks just don't act right, perform right. Something has changed. Now, just because the S&Ps or the broader indexes haven't followed suit doesn't mean they won't. And if I'm, erring on the side of probability, I'm going to tell you that, again, and certainly open to contrary opinion, I would guess, or I would forecast that, the bigger indexes will follow suit at some point. That's just my take on it, and I've been doing this for a long time. The banks and some of the things that we key on or have keyed on for clues on general market strength or weakness, again, it's just not there. Here's Goldman, and I always like to look at weekly charts. Here's a weekly of Goldman, and again, this structure to me looks like something has changed. Again, rising averages for the better part of 2012, 2013, clearly under the 8, under the 21. Again, stuck in a consolidation pattern, but very much ominous, like this thing could, potentially break down. And as the banks, possibly break down, you're going to see some of that probably bigger money or that bigger cap, those bigger cap markets, tend to follow suit. So not a very healthy looking picture that's developing here. And again, this is just one symbol, and I'm kind of throwing it out there as a benchmark. But if you look at some of the other banks as well, here's JP Morgan. Again, they're probably all structurally looking like something has changed. Bank of America, again, clearly come off. So now, while a lot of people have made a lot of money, I think, buying dips continuously over the last couple of years, as a technician, as I look at this picture, and this is, again, Bank of America, here's a weekly, again, rising 21, rising 8, over a series of many weeks, many months, only to now structurally change. Something has definitively changed. The picture has changed. The landscape has changed. You have to change with it. That's really, I think, the purpose of what I'm saying. And, while you've seen some of that momentum, those momentum names slide pretty substantially, pretty fast, you have to be either nimble and objective here, or you have to stay on the sidelines. That's my own personal opinion. Again, what makes a market unique is that it's open to debate. And for every buyer, there's a seller. And for every person that says, you got to be careful, there's probably another person out there that's going to say to you, now's the time you want to get long. I'm a technician. I look at pictures. I study the language of price. That's what I know. That's what that's what I teach. And that's firmly where I base my objectivity in terms of understanding risk in. It's not about an opinion or, what I think about the future. It's about, what does the language of price tell me, and how can I make objective, rational decisions off of that language of price? Everything else is just noise, in my opinion. So for me, or from, talking to you, which hopefully you're listening, I want to build an objective watch list to trade this market. I want to have a few low-hanging ideas in terms of longs and a few ideas in terms of shorts, so that I can be flexible with what I do and how I do it. And I'm always a big believer, and this is what I'm going to talk about in my webinar on May 20th, is that making this business, whether you're a day trader, a swing trader, or an active investor, or someone who's managing money, and paying attention to the market on a day by day, week by week approach, you got to be objective, and you got to be flexible, and you got to go with simplicity. Simplicity will make you more money than you ever realize. If you're constantly trying to fight and force your will on the market, or make something happen that really isn't there, the market's going to tell you. The market will clearly slap you in the face, whether it's today, tomorrow, or next week. So my approach has always been, and I learned the hard way. I'm going to tell you that on May 20th, and I'm going to take you through the whole evolution. But I learned the hard way that it's not my job to force my will on the market. It's my job to find the simplest looking structures and take advantage of where, easy money is. Doesn't mean you're always going to be right, but you're going to put the probabilities of success very much in your favor. And that's our job as market commentators and educators, is to help you figure out how to do that for yourself. And we do it every day, or at least we try our best to do it every day. Sometimes we do it better than other times, but again, this is trading and it's dynamic and it changes, as do markets. So we have to try and stay ahead of the curve and give you our best opinion and our best output in terms of content, in terms of risk, where risk is the least. And I will tell you that for someone who's been doing this since the late 90s, I know when the tech stocks and momentum names are broken down and the small and mid caps are breaking down, they're always going to lead. Something will follow suit. When, how much, I can't tell you that. But I can tell you is that you stay tuned, you stay plugged in, you use good products like, again, another shameless plug, here's Off the Charts. I'll bring it up on the screen. And the reason I bring it up is because what I want to focus on here is not necessarily the fact that we give you trade ideas, but we give you trade ideas. And if you're not really using a functional watch list and you're not, creating good long ideas, and again, here's our long list, and you can see stuff that is currently open and stuff that is pending, meaning it hasn't triggered yet, and what it's been yielding so far. And again, here's the short ideas. You have ideas on both sides of the table, so you're going into the battle with at least some semblance of a plan as to why. And I think a good healthy trader will, if you look at the career of a good healthy trader, to me it's always going to be a third, a third, a third. What do I mean by that? Well, a third of your trades will probably wind up going and becoming very, very profitable. Again, I'm just generalizing here, but a third will be potentially very profitable. A third of your ideas as a trader may never trigger, meaning you're watching them, they're in your watch list, they're in your universe of things that you're keeping on the radar, but nothing ever happens. What you anticipate happening never happens. So we call that a third of them never trigger. And a third of them should be small losses, things that do trigger but don't work out. So a third, a third, a third. It's not about being 80% right or 90% right or even 50% right. It's about a third, a third, a third. A third of your ideas, again, wind up being successful. A third never even occur. And a third are probably for small losses or break even or even small gains. So you're really trying to mitigate risk and take advantage of the ones that actually start to work out and continue to stay with those trades. That's my approach to trading, and the approach that I think works best in terms of what I've seen overall with people that are successful, whether again you're an intraday day trader or somebody that has a longer time frame. The concept really doesn't change. So make sure you're taking advantage of everything we're trying to give you, and whether it's off the charts or on the VTF and whatever it may be. My goal as an educator and what I'm trying to do here in the recap is just not necessarily preach, but give you just my professional opinion on what I think is happening and why I use objective data in terms of charts to help me make those statements. I'm not making them blindly. I'm not making them based on how I feel or some subjective analysis. It's based on the study and the language of price. So again, I tried to keep, although I tend to be a bit verbose, I tried to give you a couple samples of why I'm making those statements and what I'm looking at. Again, we can't cover everything. It's just a short video. But for those that are more inclined, make sure you're tuning in on a deeper level. And if you're not yielding the results you want to yield, make sure you look into some of our education products, as they will help you understand. So if you don't understand what I'm talking about, well, what is a flat 21 EMA? Or what are these rising averages he's talking about? Or why a weekly chart? Again, that means that should be your cue or your buzzword to say to yourself, maybe I don't know what I don't know and I need to find out. As always, I'm Laz. Stay tuned. 4:30 today. Make sure you sign up for the webinar, and I will talk to you soon. Have a great day, everybody.